All right, let's jump right in. If you follow the markets, you know the end of the year can get a little, well, weird. But for the electric car company NIO, a very specific and potentially huge signal may have just flashed. We're going to break down what's being called the Santa signal. So first, a little context. During the last few weeks of December, trading volume just completely dries up. The big-time traders are on vacation, and the market's moves can feel kind of random, driven more by technical charts than by what the companies are actually doing. And it's in this strange, quiet environment that opportunities can really pop up. So for a stock that has been hammered all year long, could this be the moment? Could this be a sign of a real year-end comeback? Has NIO just flashed a powerful signal for a rally? So what exactly is this Santa signal? Well, it's not just one thing. Think of it more like a perfect storm. You've got the stock chart showing some real strength. You've got the people who were selling all year finally throwing in the towel, and the whole mood around the stock is just starting to shift. Okay, to see if this signal is for real, we have to start where every big move begins, the chart. Let's dig into the hard data and see what it's telling us. This number right here is pretty much everything at the moment, $5.07. It might not look like much, but for traders and all their fancy algorithms, this price level is a critical line in the sand for NIO. So why is that number so important? Well, it lines up almost perfectly with something called the 200-day simple moving average. The easiest way to think about this is like a stock's long-term health barometer. If the price is above it, the long-term trend is generally seen as healthy, but below it, yeah, not so much. Now here's what's so significant. NIO stock price came right down and tested this critical level, this algorithmic line in the sand, and it held. It bounced. It didn't break. That sends a really powerful message that, hey, despite all the selling this year, the underlying structure here might still be solid. So if that $5 level is the floor, what's the potential ceiling? Well, the next major hurdle, which is often tracked by the 50-day moving average, is all the way up at $5.96. That leaves a potential 17% gap to the upside before the stock even hits its next big test. Okay, now let's get to the second piece of the puzzle. And this is where things get a little counterintuitive. We're going to explore why this quiet, low-volume holiday market might actually be the perfect fuel for a fire. See, normally you want to see a ton of volume when a stock is rallying. It confirms that the buying is legit. But at the end of the year, the rules totally change. The big funds, the active sellers who create all that trading volume, they're just gone. They're on vacation. And here's the main reason they vanished. For months, big investors have been doing something called tax loss selling. Basically, they sell their losing stocks, like NIO, to book a loss that helps lower their tax bill. But here's the thing. That kind of selling has a hard deadline, the end of the year. It goes from 100 miles an hour to zero, literally overnight. And when that constant, heavy selling pressure just disappears, well, the effect is pretty amazing. With the sellers out of the picture, even a little bit of buying pressure can make the stock float up effortlessly, kind of like a beach ball that's been released underwater. This vacuum effect also creates the absolute perfect trap for another group of traders. And this is where you can get some real rocket fuel for a rally. Let's talk about the short sellers. These are the traders who are betting the stock price will go down. And in NIO's case, there are a lot of them. A huge chunk of the daily trading, we're talking between 30 and 38%, is from people actively betting against this stock. So this sets up a potential domino effect. In a thin, low-volume market, it takes way less buying to move the price up. So even a small pop can cause those short sellers to panic. To cut their losses, they're forced to buy back the stock. And what does their buying do? It pushes the price even higher, which forces more shorts to panic and buy. It becomes a classic self-fulfilling prophecy. The fear from one group of traders, the shorts, ends up creating this powerful upward cycle that just feeds on itself. It's pure market psychology in action. So that's the short-term setup. I mean, a holiday rally is one thing, but why would any serious investor want to stick around for the long haul? This is where the story shifts from just trading tactics to the company's actual business. The long-term case really comes down to a major strategic pivot. NIO is launching new, more affordable sub-brands, Envo and Firefly, to attack the mass market. And maybe most importantly, management is finally shifting its focus away from just growth at any cost and towards efficiency and, profits. This is a huge narrative shift, and it's one Wall Street is definitely starting to pay attention to. The old story was growth at all costs, which meant they were burning through mountains of cash.
The new story is about becoming a grown-up company, a story that has a clear path to actually making money on each car they sell. So when you put this all together, how should we look at it? The entire setup can really be seen through the lens of risk versus reward. And the numbers here are, well, they're pretty staggering.
Even with these recent glimmers of hope, NIO stock is still down an incredible 88% over the last 5 years. An 88% loss. Just let that sink in for a second.
So what does a number like that suggest? It suggests that pretty much every piece of bad news, every fear, every possible risk might already be priced into the stock. After a collapse that brutal, the risk-reward profile becomes what traders call asymmetric. The potential for more downside might be limited, while the potential for upside, well, that could be huge.
So when you combine that solid technical floor on the chart, the fact that the sellers are exhausted, the rocket fuel potential from a short squeeze, and the company's real fundamental pivot, it all builds towards one final question. After 5 absolutely brutal years, has all of that pain finally created the perfect setup for a comeback?